welcome to Trading Day. Let's get to those big stories we're bringing you from our newsroom. Agnico Eagle is expanding in Finland with 3 deals valued at about $3.7 billion Canadian. The company plans to buy TSX-listed Rupert Resources in a deal worth about $2.9 billion. It's offering Agnico shares plus up to $3 a share in contingent payments. And Agnico is also acquiring an outfit called Orion Resources, as well as B2Gold's stake in the FinGold joint venture for over $300 million. We're going to hear more about this transaction when we're joined by Agnico CEO Ammar Al-Joundi today. He'll discuss what that means for the company, and he'll drill into the mechanics of the deal. That's set for 1:40 p.m. Eastern Time. Canadian inflation picked up in March, with higher gas prices driving the increase. Statistics Canada says the Consumer Price Index was up 2.4% year over year. But energy was the big driver, with gasoline prices surging more than 21% month over month, the largest increase on record. And food prices also remain elevated, with grocery costs up more than 4% from a year ago. Bombardier has landed a new services deal with aircraft operator Vista, worth about $300 million over 5 years. The agreement covers Bombardier's smart parts program for Vista's Challenger 3500 aircraft. The TSX flat oil is up, of course, but weighing on sentiment is uncertainty over whether the U.S. and Iran are even working towards a longer-term peace deal. U.S. President Trump talking tough over the weekend. Let's have a look at BlackBerry, though. That stock doing well. It's the maker of security software. QNX is the crucial division there, expanding a collaboration with NVIDIA to develop safety-critical AI systems on NVIDIA technology designed for humanoid robots, autonomous mobile robots, and medical imaging. A couple of big bank stocks hitting record highs. TD Bank, investors apparently trying to put behind them worries over slack money laundering controls in the US. And Royal Bank also hitting a record high. And here's the stock hitting its own a record high, Celestica. We've seen a major bounce back in some of these big tech names. Look at that chart, that 10-year chart. That stock up something like more than fourfold, if I remember rightly, in the past 12 months. And let's have a quick look at U.S. markets amid concerns that this Persian Gulf standoff is set to continue, and you can see U.S. stocks slipping. Xanadu Quantum Technologies just listed in Toronto, and it's surged over the past week or so, making its CEO a billionaire almost overnight. It's part of a recent surge in quantum computing stocks. Let's get more from Jed Ellerbrook, Portfolio Manager at Argent Capital Management. Thanks very much indeed for joining us.
Happy to be here.
There are a few quantum computing stocks out there, but it's obviously highly uncertain when they'll ever be able to sustainably post profits.
Yeah, absolutely. It's an early stage technology. There are, a handful of publicly traded companies that are trying to build hardware systems using quantum tools. But I think the big news most recently has probably been NVIDIA's announcement of an open source quantum AI model, which really kind of reignited interest in the space.
Wow. Open source, AI, and quantum together at last. So that sounds pretty potent.
Yeah, it does. It does. It really got investors excited here over the last couple of weeks. And then we've also seen a few kind of achievement of technical milestones related to the hardware over the last few weeks, too. And then I guess the third factor is probably there's been a big rally in risk assets in equity markets here over the last couple of weeks. Unprofitable companies, smaller companies, pre-revenue companies have been leading the stock market over the last few weeks. And quantum stocks obviously fit into that group.
Oh, that's interesting. Yeah, at certain market phases, investors reach out for deliberately speculative stuff, don't they?
Yeah, that's right. That's right. And quantum stocks have been, I'd say weak over the last 6 months, maybe 9 months. And then that resurgence here that you mentioned just within the last 2 weeks.
Let's talk briefly about a stock that does have a substantial business, Amazon. Now, that stock hit an all-time high next week. We are looking ahead to earnings. What are you going to be focusing on when they report? And I believe it's Wednesday afternoon.
Yeah, that's right. Amazon stock, as well as a lot of the other big tech Magnificent Seven stocks, have really staged a strong rebound over the last couple of weeks as investors seem to be gaining a little bit of comfort with their CapEx outlook and, a little bit of trust and confidence that these companies will earn a good return on that data center construction investment. We're going to see AWS, which is Amazon's cloud computing unit, report really strong revenue growth, accelerating revenue growth, perhaps into the high 20% compared to just 23% last quarter. And then the retail business keeps chugging along, doing well.
One tech stock that you would be a seller of right now, though, Tesla?
Yeah, I think Tesla trades at a really high valuation, and they do have exciting, robotic products that are, hopefully coming to market. They're making progress with their self-driving vehicle technology. They've expanded to a couple new cities in Texas here. I think they announced that over the weekend. That's all good news. But gosh, the stock trades at a really high valuation. And, I think for the Elon Musk fans, there's going to be another publicly traded investment option that might, capture dollars and take investor interest from Tesla, that being SpaceX, of course, which is planning an IPO in the June timeframe.
That'll be interesting, won't it, if there's cannibalization in terms of investor sentiment?
Yeah, I think there might be. SpaceX is going to be a much larger company than Tesla by market cap.
Yeah, that's so it'll be the big brother. What about the big U.S. banks, the likes of J.P. Morgan, et cetera? Do you see promise there? Would you be buyers of those shares?
Yeah. We think J.P. Morgan and also PNC are outstanding companies. The U.S. economy remains incredibly resilient. And so, big banks serving that, growing demand as our economy grows and also keeping credit losses low. I think that's another big takeaway from these companies reporting their earnings last week. Additionally, we see, I think pretty decent activity in M&A and IPO activity. And there's a lot of share repurchases and dividend growth coming as U.S. Banking regulations ease under the Trump administration.
One name we keep hearing is Eaton. It's a supplier of electrical equipment and an obvious winner if this huge data center build-out continues.
Yeah, Eaton is in process of spinning off their automotive division, which is a slower growing, less profitable business, so they can focus 100% of their attention on their electrical units serving data centers, big non-residential construction projects, and also the aerospace and defense industry. Both aerospace and defense and the data center end market are growing nicely, and I think that they have like kind of durable secular growth opportunities, not just cyclical strength today.
Are you worried, though, that this could be a crowded trade now, electricity and electrical equipment?
Yeah, Eaton has actually underperformed over the last year. You're right. Those investment areas are of high interest today to investors, but investors have been frustrated and disappointed that Eaton's margins have been weaker than expected. They've been weaker than expected because the company is investing to expand their output, and that's costly, especially upfront. I think over the next year, as they anniversary and move past a lot of those startup expenses, we will see margin improvement. And I think Eaton's recent strength in their stock has been a result of that. I think investors are kind of moving past focus on the startup costs of their expansion activity, moving focus to that kind of longer term secular demand. So I think it's a reasonably priced stock.
Thank you very much. I really appreciate it, Jed. Jed Ellerbrook is portfolio manager at Argent Capital Management. Coming in, fuel tax relief kicks in for Canadians today, but will rising oil prices wipe out the savings? We'll have more after the break. Ottawa is suspending temporarily its 10-cent a litre excise tax on gasoline as of today. Meanwhile, though, of course, the Persian Gulf standoff is still driving global oil prices. We got more on this and current market trends from Alan Small, Senior Investment Advisor at IA Private Wealth.
A little concerned about price of oil for those that are looking to buy oil stock. Obviously, if there is some sort of deal made, and we keep going back and forth whether a deal can be made, but if a deal is made, then I would say the price of oil will drop significantly. We've already seen it drop from over $100 a barrel to now into the high 80s, and we've seen it, I think, prior to the weekend, late last week, I think got as low as 81. So. A lot of people are saying the price of oil is going to take a while for it to come back down. I don't believe that will be the case. I think the market will be, as it always is, forward-looking. And I would not be surprised to see oil fall even below $80 if we can see a deal done between the United States and Iran. And if the Strait of Hormuz is opened, I realize that a lot of people are saying it's going to take a while for things to get back up and running smoothly, oil, natural gas, and everything else coming out of the Strait. But the market is forward-looking, and I think it'll price it in. And I think we need to be mindful of that if you are an oil investor.
Would you be inclined right now to up your weighting in oil, though, or?
I definitely not. Definitely not.
Yeah.
I think right now I'm underweight energy, and I will probably remain. So I'm more into the power generation, more the grid, electricity, and that, again, more for the data center type of investment play than the oil play. So for me, some names like a Vistra out of the U.S., GE Vernova. These are names that power generators. These are the names I think that have room to run, especially a Vistra trading very cheaply right now. So for me, I'd rather go there than an oil name at this point, which are still pretty high in terms of valuations.
Vistra, VST in New York, power generator, not a big yield. That's interesting. Only about 0.5%.
Yeah, more for a growth play in that case. That's correct.
Right, that's interesting because the likes of a Fortis in Canada. I mean, would you be attracted to Canadian utilities?
Yeah, I think I've always been more partial to Emera versus a Fortis. I gained better yield for a while, but these names also are at near 52-week or all-time highs. Once upon a time, these utility stocks were bought just for the dividend, right? The dividend yield. And here they are now, growth and income over the last little while, again, on the back of power generation, electrical grids, things like that, to power the data center, the future, as we say, right? Where we're going, with all the data center and all the power generating that we will need to power these data centers. These are the names that individual investors have migrated towards.
What about tech? I mean, we can be sure the software companies are scrambling to convince customers that they need to go on paying for high-priced services. Would you be interested in, say, a CGI, GIB.A?
Yeah, I think tech is a great place to be. We've seen it time and time again. I think the biggest thing that I'm taking out of what's going on right now with the conflict in the Middle East is opportunity for investors. We know that when there is a ceasefire or this conflict comes to an end, market gets a pretty big boost. We saw it last week. We've seen it over the last couple of weeks, and tech has been the benefactor of that. You talk about software. I think a lot of these software names, especially the big cap software names, I think are still undervalued. I don't believe that AI is going to just wipe out names like Salesforce and ServiceNow, some of the bigger software companies, Microsoft. So I think they are. I think they do represent good value. I think tech in general, Canada, U.S., Celestica is a name I was purchasing for a while there, came down quite a bit, and now back at all-time highs once again. And it is, I guess, the closest thing that we have in our country as an AI play. And Celestica, once upon a time, 50 times earnings, dropped down to under 30 times. That is the time when you start to buy the name. Now it's obviously back a lot higher. So a name like Celestica, probably a hold if you own it, maybe trim some off the top. But definitely tech are names that I like going forward. And we've seen that they are the premium or the biggest benefactor when we get some sort of peace talks or at least positive news out of the Middle East.
Actually, Celestica hitting a record high today. And as we can see, look at that, up well over fourfold in the past year. Incredible.
Unbelievable. And again, when it gets to these prices, looking at it gets a little lofty in terms of valuation. So I think it's a name that you trim back some of the profits at these levels. Probably still want to own it because the way they talk and what they're saying when they just reported results not that long ago, good numbers. And the stock was actually falling even after they reported a strong quarter. So that's where you want to be, I think. Tech makes a lot of sense here at these valuations.
NVIDIA is interesting. Obviously, they've got a massive franchise, but companies, big customers like Amazon and Alphabet, anxious to reduce their reliance on NVIDIA's devices.
Of course, and I think that is why you've seen NVIDIA, at least for the last 10, 12 months, kind of in a trading range.
Yeah.
You've seen a lot of companies like Amazon with their titanium chips. You've seen the Broadcoms with their chips, and everyone seems to be producing or creating a chip at this point in time. And I think maybe that is why investors have a bit of cold feet when it comes to NVIDIA, although back at $200 a share again. Yeah. I think it got as high as $212 on the high end. So for me, I'm actually looking at a name like NVIDIA because I think they do a lot more than just chips. They have the whole stack. They have the whole thing that they can provide, whether it's the software that goes along with it. So in my opinion, I think it's a name that hopefully can break out from this channel that it's been trading in, maybe get closer to that 2.25 range, 230. So I think investors, can migrate towards NVIDIA, although, it'd be hard to find investors that aren't already invested in NVIDIA, right?
Yeah.
Largest company in the world. So I think that also is the problem for the stock, why it can't seem to get much traction.
Alan Small joined us earlier, and he's Senior Investment Advisor at IA Private Wealth. Up next, inflation ticked up in March, but it was driven by gasoline prices. We'll look at factors other than energy affecting the national figures. We'll be right back. Birth rate in New Brunswick continues to be one of the lowest in the country. Meanwhile, the retirement rate is high and only growing. One economist is sounding the alarm on what that could mean for the province's future. CTV's Laura Brown has more on this report.
This is Bathurst in northern New Brunswick. The median age used to be 23. It's now 53. A problem, says this economist.
Making sure that, 10, 15, 20, 30, 40 years from now, if you go to Bathurst, there's actually people living in Bathurst.
Far from the baby boom, today more people in New Brunswick are dying every year than being born. David Campbell authored a new report finding the real impact will be felt within the next decade, when 20% of the workforce retires.
This is a community survival issue. We have communities that within 10 years across New Brunswick, across Atlantic Canada, where 50% of the population are going to be over the age of 65.
He projects healthcare will need to fill 30,100 jobs by 2035, construction 16,300, and retail 13,100.
5-10 years, if something doesn't change, it will become a serious issue.
Tom McGinn said they're already having trouble finding workers in construction, and the demand for new homes, roads, and bridges is only building. The key, trying to convince young people to seek employment in the trades.
You can make good money.
My wife said it was time for me to go and do something, so.
At 66, Barry Martin is trying to help in his own way. The retiree returned to the workforce after only a few years and now helps build ambulances.
They need me more than I need them. They need people. They need people that have got, that are willing to learn. They're willing to pick up a trade.
David Campbell says immigration will be critical to rebuilding the workforce and hopes the federal government becomes more flexible on its policies, allowing certain parts of the country more permanent residents where the need is greater. Laura Brown, CTV News, Fredericton.
Awesome. Let's take another tangent here into economics. Consumer prices in Canada were up. They were driven higher by energy prices. Our guest believes, though, that's not the full story. We're joined by Mauricio Zelaya, I'm sorry, partner at EY Parthenon Canada. Thanks for joining us.
Thank you for having me.
So talk to us about these latest numbers. Gasoline, fuel was the driver. A huge increase month over month of more than 20% in gasoline.
Yes, you're right. And we were anticipating this rise. I mean, from what we saw from February to March, but it's not the full story. It is somewhat consensus where it landed around 2.4%. But as you mentioned, it is more to the story behind that. If you focus on the core inflation, meaning that if we were to strip out all functions or other factors that create this volatility, you're seeing inflation actually drop. And so you're seeing this from 2.2% up to the highs in October of 3% and even February from 2.4. So you're seeing this slow decline, or it's moderating inflation. So the story here is more so importantly around that it's being contained, and I wouldn't interpret this as a reacceleration of inflation in Canada.
We have a couple of charts, one from StatsCan today showing just how this fuel bump distorted the figures really in the latest months, because we can see CPI still in a gentle decline. But when you include gasoline, it did post a brief jump there.
Yeah, absolutely. And we're seeing this, so to your point, month over month, 21% increase in gasoline. Year over year is about 6%. And then even focusing on food inflation as well, that's still there. So you're seeing a lot of these movements into the broader, I'll call it headline CPI, but it's really important to disentangle some of those factors. And even to take this a step further, understanding the baseline effects is even equally important as well, meaning that from 2024 December to February 2025, if you recall, we had the tax relief system as well.
The GST thing, yeah.
Exactly. Now in March, it's actually been an uptick. So the denominator has actually risen. So therefore, as a result, we'll also see a lower decline. So that's also, there's a lot of moving parts right now.
And you mentioned these measures of core inflation. I think we have another chart that shows that. Two of the Bank of Canada's preferred measures, TRIM and median, and both of those slowing, or certainly still contained.
Exactly. It's really telling more, this is a demand-driven story. It's quite weak in Canada. You're seeing the Bank of Canada have in fact, forecasted GDP to only be about 1.1%. So this is really a supply-driven shock right now. It's quite temporary, but what that does mean is they will be really eyeing us on how this will, whether it's going to persist or whether it's actually going to flow through the supply chains, and as a result of that, to react accordingly.
Wow, but if it does prove persistent, it'll be running into weak demand, weak economic growth in Canada.
And that can be a concern, definitely. And for us right now, what we're observing is while the core is still being moderated, this will certainly be top of mind for banking to observe this, because recognizing that the announcements of next week, I'm fairly confident it'll likely stay the same, only because if there's an increase of price, it's going to put further pressure on consumers and producers. If you were to reduce the rate, it might actually further expedite this inflation, which right now is just, I'll call it rather temporary and contained from a supply shock.
Can we just switch? You mentioned to me in the break on the subject of inflation. We have these so-called nation-building projects rolling forward, infrastructure, high-speed rail, you name it, mines, the Port of Montreal. But our economy has constraints in terms of people and the availability of materials.
Yes, and right now, all the announcements are great. It's giving us a direction in terms of where the economy should be going right now. But it's going to set us up very strongly in the long term. Right now, the question becomes around execution, around prioritization. This is going to put a lot of pressure both on our industrial base, our Canadian capacity, from the peoples, from the sector, and also the products that we're developing. And as of now, and as it states, it's really important to understand which elements that we can make those investments now to help support all these projects. Because as we know, our goal isn't to be our goal rather is to be less reliant on the U.S. right now, and as a result, it requires some of these investments, help incentivize businesses, think about trade of goods and services that flow from east to west as opposed to north to south, as an example, and more so from an economic sovereignty perspective to ensure that we have a strong, resilient domestic supply chain.
I guess housing is going to fit into this because if you're building a big project in a lesser center, there's nowhere for the workers to live.
And that's going to be also challenging as well. We've seen many announcements on affordable housing, which is great, but there's equally also different, unique challenges there. For example, how is it that the federal, provincial, and municipalities are going to work together on this, on the coordination aspect? Ontario is very unique in terms of the development charges, as an example. And while we've seen some announcements to help, relieve some of that pressure, it's a question around incentivizing construction workers and businesses to really activate this. And one area that we often don't talk about too much in Canada is around the regulatory approvals. The goal here isn't to deregulate ourselves, but rather to be able to optimize them so we can move forward on all these projects.
More quickly, yeah. course, bureaucracy is pretty easy to get, pretty hard to hack away at. It's like a creeping vine.
Yeah, exactly. And I think for us, that's where we're trying to understand what policies and put in place are very effective. What areas is it that we can actually help support businesses, expedite, incentivize? You've seen Prime Minister Carney really announce the attraction of private capital and to have these large players come into Canada, which again is great. The goal here is to attract private capital, but at the same time, how is it that we activate it? And that's where there's all these different factors come into play, from the regulatory approvals to move these products quicker or to get these projects up and running, but also the core element of the industrial base, the domestic capacity, has always been an issue in Canada. And it's great to hear that Canada is focused on a Canada First procurement strategy. That's fantastic. It's also going to put further pressure into these existing industrial sectors.
And you guys at EY Parthenon, you're working on with some of these big projects.
Yes, absolutely. And for us, that's where we really see and really understand these projects quite well. And the goal here is to really say, hey, some of these investments should have been made many years ago, and now the next best time to do it is now. So this is a great time. Now, as we think about the long-term perspective, we also have to think about the short-term. What is it that we can do now to be fiscally competitive, not only domestically, but also globally as well?
Mauricio, thanks very much.
I really appreciate it. Thank you.
Mauricio Zelaya, partner at EY Parthenon Canada. Coming up, could government-run grocery stores help tackle food inflation? We'll hear from a skeptic after the break. Let's take another look at shares in BlackBerry, jumping 11% today. That's after the Canadian software supplier announced an expanded partnership with NVIDIA. That deal will see BlackBerry's QNX division working alongside the chip giant to develop what's called safety-critical AI systems for NVIDIA's IGX Thor platform. They plan to support AI use in autonomous mobile robots, humanoid robotics, and advanced medical imaging. Marvell shares are up today. This comes following a report from The Information that Google/Alphabet is in talks with the chip designer to develop two new devices aimed at running AI models more efficiently. This potential deal could involve a memory processing unit to complement Google's so-called tensor processing units. They speed up calculations, and a new TPU built for running AI models. The signal here may be that Google is seeking alternatives to NVIDIA's pricey chips. Ottawa's temporary suspension of the excise tax on fuel kicks in today, with Canadians in theory saving 10 cents per litre on regular gasoline and 4 cents on a litre of diesel. Last week, the Prime Minister announced a pause on those excise taxes until Labour Day. The measure will cost more than $2 billion. And there's a look at the TSX, pretty flat today, despite something of a recovery in oil prices amid fears of continuing tension in the Persian Gulf. And let's see how that's playing out on the U.S. bourses right now. American stocks, of course, hitting record highs last week, but they are slipping today. Last time I checked WTI, it was up just over 6% to just over $89 US a barrel. Government-run grocery stores have been having a moment, with New York City's new mayor popularizing the idea and Canada's new NDP leader, A.V. Lewis, using them as a key component in his campaign. Toronto City Council has passed a motion to open 4 government-run grocery stores. We got more from Alex Whalen, Director of Atlantic Canada Prosperity at the Fraser Institute.
government-run grocery stores likely will not be as efficient as grocery stores that operate in the market. You're exactly right to highlight that government could set the price of bacon from $6 to $3. In fact, government could set the price of bacon to zero. But the key point for the taxpayer and the consumer to understand is that that does not make it costless. If Toronto City Council or any other city council in Canada decides to open grocery stores, those costs will show up on the backs of taxpayers somewhere.
I guess partly your argument indicates that grocery stores are not profiting unduly, that there is adequate competition.
Well, I wouldn't go as far as to say there is adequate competition. In fact, I think that highlights a key point, which is that government's role in this space, I think, is to promote competition, reduce taxes, reduce regulatory barriers. I haven't looked specifically at the degree of competition in the grocery industry in Canada, but what I can tell you is that state-owned grocery stores would be a very costly solution. That's the main point that we're trying to make in our piece.
It seems a bit of a gap that you haven't looked into whether the grocery stores are actually competing, because if they are earning undue profits because of oligopoly factors, that would indicate that the government stores could offer lower prices.
Well, certainly I could tell you anecdotally that anybody in Canada can open a grocery store. There are relatively low barriers to entry.
Well, I don't know about that. It's pretty capital intensive.
Well, sure. But I mean, if you look at, you raised the example of New York City off the bat, there's a government-run grocery store being opened in East Harlem. And many of the people that are against it are actually very small business owners, owners that are running small corner stores and bodegas. And so, I mean, there's lots of different ways for people to participate in this industry.
I wonder, I mean, the government has said, or the Liberal government has said in the past, we'd like to bring in foreign grocery chains. They haven't. The likes of Aldi and Lidl are in America, but they haven't come into Canada. So it seems like this is not that attractive a market.
Well, I mean, there is the broader Canadian business landscape, which I think has been challenging in recent years. Taxes have gone up. The regulatory burden has gone up. In general, I think government removing barriers to competition is a great policy solution in this space compared to, again, nationalizing grocery stores.
Right. You'd like to see that. And they have leaned to some extent in that direction, as you know, combating these leases whereby if I open a grocery store, I can get the landlord to ban any other grocery stores in the same development. So the government has leaned towards that, but you'd like to see more encouragement of competition.
Absolutely. I mean, consider, Andrew, that we're talking about grocery prices at the core of this issue here. One of our publications has shown that taxes in Canada have actually increased at a greater degree since 2020 than grocery prices. And so that just highlights one example of how governments could actually undertake productive reforms in this area.
I wonder, even if it costs taxpayers money, and like everything costs, if they open a few stores, would it tend to stimulate competition, though? Because people might go into the government store and say, well, it's only this price. That would put pressure on Loblaws and Metro to do a better job of matching it.
Well, it would certainly put pressure on the other competitors in the industry, but at the end of the day, government has no bottom line, so they can pass that subsidy, which is effectively what it is, onto the consumer. Right.
Obviously, they're spending other people's money. So would you bring down burdens such as planning fees, I guess, these infamous development fees, so that people could build rival food stores more cheaply?
Yes, I think we should make it as easy as possible for competitors to come into this space. That should be true across all industries. If we want to see competitive pricing, you need relatively low barriers to entry. And there are a number of other ways we should note as well that governments drive up the cost of groceries in Canada. We have a system called supply management. You mentioned land use, regulation, taxes and fees, and so on.
The government, I mean, it has been tried in some places. Mexico has thousands of government-owned grocery stores. It's a very different economy from Canada, but some places have made it work. I know that the record is mixed.
Sure, and I think it's important to look at our own record in Canada when it comes to nationalizing industries. I mean, the federal government in Canada, as you probably know, used to own an airline, used to own a national railway, used to own a national string of gas stations. In general, I think the lesson from those experiences is that government shouldn't be in business and government should focus on their core functions.
Alex Whalen joined us earlier, Director of Atlantic Canada Prosperity at the Fraser Institute. Coming up, Hot Picks, we are going to zero in on 3 ideas in retail with a focus on beauty and wellness. We'll be right back. Today on Hot Picks, we focused on 3 retail ideas with a focus on beauty and wellness and health. We kick things off with Ulta Beauty. Our guest was Susan Anderson, Managing Director at Canaccord Genuity. First off, we asked, what is Ulta Beauty all about? How do they make money?
Ulta is kind of an all things beauty and wellness specialty retailer. They specialize in mainly beauty, but they're also adding wellness to their mix. They have a kind of newish CEO, Keisha Steelman, at the helm now, who's been winning back market share with her Ulta Beauty Unleashed strategy. They recently beat their fourth quarter comp sales expectations against a pretty high bar. This is really being driven by market share gains, with Ulta now gaining share in both prestige beauty and mass beauty after struggling in some prior years from Sephora's massive store rollout here in the U.S. We just met with Keisha at Ulta Beauty World in Orlando, and she talked about how they're very focused on brand relationships now and is focused on helping new brands grow and then also offering more exclusives in store. I think this is really what's helping them to win back market share with new popular prestige brands, and then also rolling out upstart mass and masstige brands. And then also they were kind of first to really focus on K-beauty in the stores. They recently also bought Space NK in the UK, which is helping them accelerate their international expansion. And then they're also kind of a first mover in all things tech. They recently launched on TikTok Shop, and they're soon to be on Google Gemini for shopping. We expect all of this to continue to drive market share gains and then also drive growth above the industry. The stock has pulled back a bit now. It's off 22% from its highs and trades just under 18 times versus low 20 times in the past 10 years. So we think this is a really great buying opportunity for Ulta.
Talk to us about Inter Parfum. I hope I'm pronouncing that right. They are huge in the perfume and scent business.
Yeah, correct. Yeah. So fragrance continues to be a top performer in beauty, with fragrance sales trending double digits in the last 3 months, according to Circana. We think that IPAR is well positioned to take advantage of the strength in fragrance as more consumers in the U.S. are now using fragrance in their daily routines. IPAR did struggle a bit last year, even as fragrance sales were strong because retailers pulled down on inventory. This led to some very conservative guidance for this year. They're saying that sales are going to be flattish, even though sell-throughs to start the year continue to be double digits. So we think there's upside to the numbers. They report their first quarter sales on Wednesday, and we're estimating sales to be at 4.8%. The street's at 4.6%. If they beat this, I think it'll be a good indication to start the year, and we would expect multiple expansion from the currently historically low levels. Right now, they trade at 17.5 times next year's earnings versus mid-20s range over the past 5 years. This is really the lowest level we've seen since the Great Recession. They also have a lot of newness coming. They just launched their Solferino brand this year. They have Off-White coming next year, and they just recently bought 2 new licenses, David Beckham and Nautica, which will roll out in the next couple years and add to growth. So we also think this one is a really good buying opportunity on these lows. And finally, Edgewell Personal Care. They seem to be big in the shaving business. Among other areas, they own Schick and Wilkinson Sword. Yeah. So they've also struggled over the past couple of years. The wet shave environment has been pretty competitive. You know, we saw Harry's come into the market, Dollar Shave Club, Billy, which they ended up buying and they now own on the women's side. But that's really resulted in some lower growth in the U.S., even though internationals continue to be strong for them in the wet shave business. They also are higher levered at 4 times. Most players are 2 to 3 times, which I think has hurt their multiple. However, recently they sold their fem care business, which will allow them to use those proceeds to get down to 3 times leverage this year. So I think investors will be happy with that. This should also help to boost margins, as it was a lower growth, lower margin business. And I think they have opportunity to get back to pre-COVID EBITDA margins, which is 400 basis points higher than where they're at now. Every 100 basis points of margin expansion would lead to incremental 34 cents in earnings. So I think it's a great opportunity. Also, with the fem care business now sold, they're doubling down on wet shave and their sun business, which is kind of their core brands. We're already seeing improvement in the sales this year. Second quarter top line in the sun care business is off to a really strong start. So we also think they could be the second quarter this year when they report. So this is another one that we would own here. It trades at 10 times next year's numbers. Historically, it's traded at 12 times. And I think there's opportunity for multiple expansion from there, just given the deleveraging.
We were joined earlier on Hot Picks by Susan Anderson of Canaccord Genuity. Still ahead, market movers with Bloomberg's Natalia Knežević. We are going to be talking, among other stocks, about Eli Lilly and Compass Pathways. We're joined by Bloomberg's Natalia Knežević. She's got her eye on 2 healthcare-related stocks. Thanks very much indeed for joining us, Natalia. Start off with Eli Lilly, please.
Thanks. It's great to join you guys today. So yes, Eli Lilly shares were flat today, but we saw a big announcement. So the company aims to buy a company called Kelonia Therapeutics for about $7 billion. As a result, it can get access to drugs that treat blood cancer. So Kelonia, it has a main drug that aims to treat patients with a form of blood cancer called multiple myeloma. So the company right now is enrolling patients in early stage trial of this drug. And now we also know that investors are kind of mainly focused on Eli Lilly's weight loss treatments, but the company is also a really big player in cancer treatments as well. Remember in 2019, it bought Aloxo Oncology for about $8 billion. So some analysts see that as a positive development in that part of their portfolio.
And then a stock called Compass Pathways is on the radar, and they're involved in possible psychedelic therapies.
Yeah, so we see many psychedelic-related stocks are up today. So one of them is Compass Pathways. The stock was up by about 25% today. Now it is up by 42%. Wow. So it's a huge gain. So President Donald Trump signed an executive order to expedite research and access to different substances outside of the U.S. to treat post-traumatic stress disorder. So that applies to psychedelics with the so-called breakthrough designation. So in short, when a company does research trials and then it applies for FDA for the approval, typically it takes 6 to 10 months. Now it's going to be between 1 and 2 months. So it is a big, step forward, and many analysts are really expect that it's going to boost psychedelic-related stocks in the near-term future, so not just today.
Natalia, thank you very much indeed. Natalia Knežević of Bloomberg, updating us on a couple of U.S. stocks of interest. Let's have a look at the broad markets now. We have seen some pressure amid pessimism that the Iranians, for one, are reluctant to resume talks with the United States while America goes on blockading Iranian ports. And so it looks like there could be a standoff there right now. There was a report, though, that U.S. Vice President J.D. Vance was headed for Pakistan to try to get talks going again. But investors, really stocks hanging fire today until there's more clarity on whether the current ceasefire will be renewed. And there you have it, the S&P down 1/3 of 1%. A couple of stocks that of great interest to Canadian investors, TD and Royal Bank. Maybe we can put in a 5-year or 10-year chart for those two. Those two both hitting record highs today, two of the biggest banks. And TD, it's interesting. Investors seem to be putting the concerns over slack money laundering controls behind them. Thanks, Control Room. And thank you very much for watching this edition of Trading Day.